All right, thanks a lot, James, for the introduction, and thanks for everyone to showing up so numerously. So, well, as the title says, so this is a paper about CBDC and privacy in the digital economy, and it's joint work with Toni Ahnert, who just joined us from the Bank of Canada, and Cyril Monnet from University of Bern. And as many others, I'm a central banker, so the usual disclaimer applies. Okay, so let me get started right away. So the background or the motivation of the papers is pretty simple. As we all know, the economy is going more and more digital. And what that means in terms of payments is, well, if you want to do business online, there's a need for digital payments, right? And you can see it quite easily. I mean, there's not so much good data, but so even bad data can make the point of something that's very, very obvious. So here on the left-hand side, you can see the growth in e-commerce, both on the consumer side and on the business side. And on the right-hand side, you can see some data that comes from payments diaries. And so you see very much as digital business goes up, as e-commerce grows, the use of cash is declining. And you can kind of even see that it's taken so at an accelerated pace more recently, right? So from there to privacy, it's not very far because, as we all know as well, electronic payments outside the cryptosphere, well, actually, even within, if you want, they generate a lot of data, right? And that's very different from cash. Since it's a bearer instrument, typically no data is really created. And so then also over time, maybe not directly related to payments, but sort of that is growing right now as well, people have become more and more concerned with the overall topic of privacy. They've noticed that, whenever you do things online, there's some form of a trace in one way or the other. So that's what you could label privacy concerns. They come in different flavors or fashions. So some are more something, I'd say it's not very tangible. So it's more like I label it here Orwellian, but you can label it differently as well. So it's more like somebody has access to my data and I don't like that. Why? Well, it's hard to grasp, but I guess a good example was the Cambridge Analytica and Facebook scandal where, lots of people's data got used and there was no consent and people didn't feel very happy about that. But of course, there's also more direct economic concerns, and that relates to things, like price discrimination on online marketplaces, potentially even for preference, manipulation, all these type of things, right? So that raises a lot of questions, and some of the questions we're trying to deal in the paper, so privacy and payments, what are the associated trade-offs, and in particular also related to the debate on CBDC, are there any implications for CBDC design, or what can we take away from these trade-offs for CBDC design? Okay. Since it's not a super long presentation, so I won't be able to present really the full paper, let me first summarize, and then let's see how far we get walking through the model. So in the model, there's some sellers or merchants. As the name says, they're trying to sell some goods, and they can do so in two ways. They can either choose to distribute their goods online, think of a web portal, via some platform or marketplace, or they can sell their goods in the classical way, offline, think of a brick and mortar store, somebody selling kava downtown in a shop, right? The way we model this, or the trade-off that we think arises from this is, well, online distribution, on the one hand, is very efficient. But at the same time, if you want to distribute your goods online, well, you have to accept digital payments, and that generates some data at some point. So in particular in the model, the merchant needs a loan from the bank, and if the merchant uses digital payments, well, the underlying payment flows, they will provide information to the financier, and that is not always in the interest of the merchant, right? And then the basic trade-off that arises from that, that's kind of the recurrent theme of the paper, if you want, is that on the one hand, online distribution is efficient. On the other hand, if you stay anonymous with cash, you can earn some informational rents that otherwise get earned by the financier, right? So those informational rents are accrued to the merchant, and that's, if you want, the value of anonymity or privacy that the merchant reaps, right? So then you have in the model, the merchant makes these choices, and then sometimes the merchant opts for distribution offline, and that is socially inefficient in the model. So there's a welfare loss associated with the private choice for privacy that's not socially optimal in the model. Of course, we can think of other reasons why privacy may also have social benefits, but that's not the theme of the paper here. It's always optimal to distribute online. Okay. into that simple trade-off between cash and digital payments, which we think of bank deposits, you can think of it as a credit card if you want, then we introduce a CBDC. And we introduce a CBDC first in the way I guess many policymakers think about it, many others think about it as well, so sort of what we call digital cash. So that allows the merchant sort of to reach the sweet spot because on the one hand you can distribute your goods online, at the same time there's anonymity, so you can engage in online distribution, as we write it here, without privacy concerns. So you can get the best of both worlds, right? And then we have a bunch of extensions in the model. So there's a platform at some point. The platform can compete with a bank in lending. The platform can also provide payment tokens, so that then generates sort of trade-offs. Who has the data? Who can provide lending? Is there competition or not? We have further extensions about competition in the digital sphere. And then at the very end of the paper, we also introduce a CBDC with data sharing, which is actually something you'll see if we get there. And that is something that will lead to the first best in the model. So that will get rid of all the information frictions that are there, and that will maximize social welfare. OK, that's the paper on one slide. Let me get into details. So as said, there's a bank. The bank is a monopolist, and the bank provides a loan to a merchant. Or the other word, the merchant requires outside finance from a monopolist bank. So then the merchant gets to choose whether he wants to distribute the goods online or offline. And that, the way we model it, has two implications. So first, offline distribution is less efficient, or online distribution is more efficient. So it's in a way, so these merchants, once they have chosen, they can have different types. That type is realized, and they can be either high type or low type sellers. And then when they distribute those goods, they can meet high and low type buyers as well. And what we basically then have is that if you choose to distribute your goods offline in this brick and mortar shop, you can have a larger variety of matches, and many of those matches are inefficient. So in particular, the way we set up the model, there is only an efficient match if a high type seller meets a high type buyer, right? And basically, when we have the brick and mortar shop offline distribution, matching is random, while if we have online distribution, as you can see here, matching is efficient, and then the high type seller will always meet a high type buyer, so this UH, this larger social surplus, is generated more often, right? So by and large, online distribution, more efficient matching. This term here, Q times 1 minus Q, that is the efficiency gain from distributing your goods online instead of offline. That's the efficiency gain in the model that will pop up a few times. And then also when these buyers and sellers, when they meet, they will engage in nice bargaining, and there's some other parameter which, well, I'll keep it short on equations, of course, but it's something that pops up as well. It's whenever the buyer and the seller, they meet, they negotiate, well, they engage in nice bargaining, and that the buyer, he reaps a share sigma of the surplus that is created in these bilateral matches. So that's one feature of online distribution. And the second feature of online versus offline distribution, the second feature is the data that is generated. In particular, if you go online, well, you must accept electronic payments, and the fact that you do so then will reveal your type, the seller's type, to the bank with certainty, right? So the payments generate some data, and then the bank can see this data and learn from that. On the other hand, if you distribute the goods offline, you can also accept cash. So in fact, you can also accept electronic payments, but well, if you decide to accept electronic payments in the first time, you might as well go online. So for simplicity, let's just assume here you can only use cash or only accept cash when you go offline. So the feature then is basically the bank doesn't get any data, right? So it's efficiency versus what data is generated or what information is generated. Well, then you may say, Peter, very nice, but what's with this data in the first place? So why do we need that data, or why is that data interesting in the model? Well, there's a second stage in the model where the merchant has some future business, and the way we model is basically only the high-type merchants, they generate a future surplus of theta in the future, while the low-type sellers, they never generate any surplus. So basically think from the perspective of the bank can give a second loan to the merchant, while the bank faces adverse selection because only some of the guys, they create a surplus. So you want to identify those H sellers in order to make a good lending decision in the second stage. That's basically why the data is relevant or needed in the model. Okay. And what you can kind of see from all of this already is that online distribution, it leads you to the first best because it means basically there's no information friction in the model, right? When the data is, when electronic payments are used, the bank has the data, and the bank can then engage in efficient lending in the second stage. And sure, we can talk about how the surplus is divided, but from an overall welfare perspective, that's the first best, right? You get efficient matching. Only the, we're here. The good matches are produced more frequently, and at the same time, we also get this very efficient this very efficient refinancing decision. So there's no market selection. Okay, so that's the setup of the model. It's a bit involved, but I think it's quite intuitive. Online distribution creates data, but makes sure the goods are distributed in an efficient way, and that leads to a trade-off. Okay, so then in order to solve the model, well, at some point, the bank needs to decide when and how to lend. So when the sellers say offline, there's no data that, if you want, drops into the lap of the bank, but the bank can do something else. And how we typically model this, well, there's a screening. And so the bank can offer a menu of contracts, and it can obtain some information from that. So the way we set up the model, without going into too many details, the bank can essentially choose between 3 different contract menus. It can offer a fully separating contract. It can offer a partially separating or partially pooling, however you want, contract, and can offer a full pooling contract, right? And so basically, the bank has to decide on the one hand how much I learn, and then how much does this cost. Why is the bank interested? Well, as discussed already in the previous slide, that affects the bank's refinancing efficiency, and at the same time, of course, since contracting is costly, if I want to learn more as the bank, I have to leave some rents to the merchants because the merchants are protected by privacy, and I need to sort of offer them a contract menu that induces them to reveal some or all of the information. And then, we can solve this. We can look what are the types of contracts that the bank can offer. And when we do that, basically, we get a nice trade-off that is illustrated by this inequality here. Basically, when this efficiency gain from online distribution is sufficiently large relative to this term here, which, basically is a shortcut for the rents that the bank needs to leave to the merchants in equilibrium. If the efficiency gains are sufficiently large, or if the informational content is sufficiently attractive for the bank, then it will always offer for separating contract, which means it will fully identify all the high-type sellers in the economy. And if the inequality goes the other way around, well, then full separation is too costly if you want, and then the bank will only offer a partially pooling contract, and that will mean it will not be able to engage in fully efficient refinancing. So in this partially pooling or partially separating, however you want, equilibrium, some of the high-type sellers, they have bad outcomes, and they're bunched with the low-type sellers. And this parameter lambda here, just that you don't wonder, since it pops up on the side, it indicates the bargaining power that the sellers have vis-a-vis the monopoly bank, right? That's a 15? Okay. Was worried that it's a 5. All right. So if we plot this then in a parameter space, we basically see that you get a separating contract for high lambda in intermediate Q, and in particular, we have this term Q times 1 minus Q. So that is maximal when Q is around 1/2, then is when the efficiency gains or whatever the bank can learn from contracting is the highest. In that case, then the bank will offer for separating contract, and otherwise, as said, partial pooling. So that is what the bank can do, and then the bank can offer those contracts to the seller, but the seller, of course, can always also opt for online distribution. And then the seller, in that sense, faces a similar trade-off. It gets some contracts offered by the bank, and they can say, well, these contracts are conditional on offline distribution. I can either opt for the contract that you're offering me, or I can do for online distribution. Of course, the seller anticipates, since it's in equilibrium, what the bank will be doing. Well, the seller then can choose. So again, the seller has the trade-off between I can distribute goods more efficiently online. I get a share lambda of this, right? So if I distribute goods more efficiently, I can reap some of those efficiency gains. But at the same time, of course, if I stay offline, there's this informational rents that I can extract because the bank doesn't get the information for free. It has to elicit it, and that is good for me. that gives some additional surplus, right? So offline distribution is inefficient, but because cash is anonymous, I can get something else out of it. Okay. So and that is then how the equilibrium looks. So that is the same figure we had before, but now we're adding some color. So that hyperbola here is delineating the parameter spaces between where there's a separating or a pooling equilibrium, or partially pooling, or it's also partially separating, however you want to think about it, offered by the bank. And then the areas here in color is the parts of a parameter space where the merchant actually opts for online distribution, right? So in this case, the rents from the perspective of the merchant, they're not attractive enough, so the merchant is better off distributing online, right? And so if we want to think about it again, when does online distribution happen? Well, it happens when lambda is relatively high, right? So you see that down here where lambda is low, there's typically no online distribution. So online distribution only happens when the merchant can get a sufficiently large share of the efficiency gains that are rising from the offline distribution. And then the other thing is related to Q, which, if you recall at the beginning, Q is the proportion of the high-type sellers in the economy. So these guys, as is typical in a screening model with adverse selection, the higher types, they always earn some informational rents. So you can see when Q is very high, there is never online distribution, right? So the high types, they always got some information rents. If there's sufficiently many high types, there will never be online distribution. There will always be offline distribution. The rents from privacy or anonymity, they're more attractive. Okay, so far so good. That's the trade-off between cash and, if you want, bank deposits, digital payments in the classical form, how we know them. Now we can add CBDC to the model. The way we do it, as already mentioned, is what we can call digital cash. So really think of, in the simplest case, some form of a virtual banknote, if you want. So it really hits the sweet spot. You can stay anonymous if you want, no data is generated, or at least that's how we model it. But at the same time, you can distribute goods digitally, right? So they can be used for online sales. So what we then have also, since CBDC can be used for offline distribution, that is always the thing that is more attractive from a distribution perspective. And the bank anticipates that, and that means that the bank always offers a separating contract. Because to be honest, if you do online distribution, there is no more thing such as partial pooling because there are fewer matches in the model, right? So essentially what the CBDC does is it enables the sellers to capture the best of both worlds. You could get the efficiency gains from distributing online. At the same time, no data is generated. That forces the bank into screening. That is good for the seller because some informational rents are generated, and that prevents the bank from appropriating the entire social surplus, right? However, what you see that at equilibrium, still in some instances, cash is used. And the reason for that, it's maybe a bit evolved, but that's how these contracting models work, is essentially because when you engage in offline sales, more different types of matches are created, and that sort of garbles the information, if you want, that the bank can extract through contracting. And in some instances, under some parameters, offline sales can still be attractive for the seller because the rents that can be generated from that are higher than rents that can be achieved from CBDC, where rents are lower, but online distribution is possible. But in some still offline, in some instances, may be more attractive, right? So we can illustrate this here as well. So if you want, the darker shaded areas is where we had offline distribution before. And now we move to a new world with CBDC where both there's online distribution in the dark and in the lightly shaded colored areas, and you only have offline distribution in this sliver here that is still in white. So in the model, there's two sources of welfare gains from this change. So first, because of CBDC, while it's more attractive to engage in digital distribution, that increases the matching efficiency in the economy. So remember, there's this high surplus that is generated when you have good matches. So those occur more frequently. That means there's more social welfare is reaped in equilibrium. At the same time, also, because the bank uses always a separating contract with CBDC, the bank is, for more parameters combinations, if you want, the bank is informed, or just the bank is more informed, and that also improves the efficiency of refinancing. That means more social surplus is reaped in the future, in the second stage of lending. That is also good for social welfare. Okay, so there's our model with CBDC. Then we have a few more extensions. I have like 3 minutes, five. All right, perfect. Let me talk a bit more about it. Okay, so we have 2 extensions. The first one is with a digital platform. So basically, what we say there is, well, now let's put a bit more structure on these online sales. So we assume that online distribution takes place via a digital platform. That platform is quite passive, but what it does is it offers refinancing. So for this continuation loan, the bank now potentially has to compete with the platform, depending on who is informed and who's not informed. And that platform that's related to this can distribute some digital tokens, and whenever the merchant allows his sales to be settled with those digital tokens, well, then the platform gets some of the information. And that means the platform could potentially engage in lending, right? And so the main results that we have under that constellation is that the tokens actually crowd out CBDC. So it's quite a strong result. You may also argue that maybe it's worrying from a policy perspective, because it means regulators or central banks need to produce something that is sufficiently attractive. Maybe it could be get crowded out by private sector solutions. But so the question is, why does that happen? So in the model, if tokens are used, this is the only way that we can have multiple informed lenders in the model. That means we have competition in the lending market, and that is very good for the merchants, because before the merchants faced a monopoly, bank no longer. So basically, how does it work? Well, the bank, as we learned already before, it can also learn from contracting. It can engage in screening. So if the seller allows for sales to be settled in tokens, well, that's the only way both the bank and the platform can acquire the information that is required for lending. And then you have competition in the loan market, and that is to the benefit of the lender, right? However, the equilibrium is still not fully efficient, because competition in the lending market is not perfect, and the reason for that is, well, the bank is still a monopolist for the first loan, so it means it can claw back some of the rents that it has to give up through the first loan, so it kind of can recover them, if you want, through the back door, and also separation is not necessarily feasible anymore, and that is because of the incentive compatibility condition, basically because now there's multiple lenders. The bank cannot sort of threaten the merchant necessarily that there's no financing at all, and there's a different condition, but that condition basically says that separation is not always feasible, right? And as said, so this result sort of provides a potential, challenge for the policy side, and whatever is created or designed in terms of CBDC, well, it has to compete with private sector solutions, and if we were to design a CBDC that is fully anonymous, at least from the perspective of a model, that could sort of come out second in competition with tokens designed in the private sector. Okay. And this is how the equilibrium looks here, and basically you see online sales as a result of these tokens that create competition in the lending market. Online sales still expands, so the equilibrium is yet more efficient than the previous one. However, there's still a sliver left where we have suboptimal outcomes, where merchants still go for cash because the rents that are generated, they're still sufficiently juicy, because lending competition is not perfect. And then we have a second extension, and that sort of builds up on the previous, and there's a very nice quote from a Journal of Economic Perspectives paper. So privacy is not the opposite of sharing, rather it's control about sharing, right? So really, anonymity is only one part of privacy. It's not exactly the same, and it's really about who has control over what information, or do individuals have the control about their information. So what we do then in the model is we consider a CBDC with data sharing that basically enables the merchants to reveal information to other parties. And if you do that in the model, it's quite simple to solve. Then the sellers, they can reveal their type after repaying the initial loan to the bank. So that takes everything away from the bank in terms of monopoly power. And then you get perfect competition for the second loan, and in particular, you get the first best outcome in the model, so there will always be online distribution. Okay, so I think I'm probably just on time, so let me just conclude. So we offer a quite stylized, but I think still quite interesting model of financial intermediation in the digital economy that tells us something about privacy in digital payments. It's stylized, but I think it captures quite a key trade-off. So we have online distribution, it's more efficient, but it raises these privacy concerns. So they're not exogenous privacy concerns, they really come out from the model as sort of an endogenous contribution, if you want. In the model, at least in the basic version, the sellers, they may choose to stay offline under certain parameters, which is something that is in that sense privately optimal, but of course socially it's inefficient because some welfare is lost. This can be improved upon through a CBDC with anonymity because it helps to address at least part of that information friction. So it enables digital distribution, but takes away at least some of the privacy concerns of the merchants. And then we have these additional extensions that I just showed you, including that with the CBDC, with data sharing, we can get the first best outcome. So thanks a lot.
Okay, thank you for here, and special thanks to the organizer for bringing my paper on the list. Yeah. Okay, the topic that I'm going to talk about is the currency and privacy. Okay, so nowadays we use electronic payments for our daily transaction a lot. So we use debit card, PayPal, and also in China, most of people use WeChat Pay and Alipay. So we use electronic payments or digital currency quite often. Electronic payments differ from traditional cash in many respects, but in particular, they are different in terms of keeping privacy. So cash retains user privacy, right? E-money. So in the paper, e-money means digital currency. Okay? E-money transactions are collected by the company that operates the system. So PayPal can observe PayPal transaction data. And these payment data can be used for commercial purposes, in particular when they are combined with personal information such as address, ages, or some education level, for example. And this payment data, the importance of payment data has increased with the advances in analytical technology such as machine learning. And in this paper, I construct a monetary model which private company issues e-money and estimate consumers' preferences using e-money transaction data and sell that preference information to producers who use that information to produce more customized products. Okay? And use the model to study under which condition e-money is used in the economy and analyze welfare implication of the e-money business and how monetary policy affects the e-money business, and also study how market structure, in particular in terms of the level of competition among e-money issuers, affect real allocations and welfare. Okay? And let me briefly talk about the key result of the paper. So in the model, the value of preference information that can be used to produce customized products increases with the trade volume in the economy. Furthermore, the trade volumes tends to be higher when the value of preference information is high. So there are reinforced interaction between the trade volume and the value of preference information, and as a result, we can have some multiple equilibrium under some condition. And second, so if inflation is sufficiently high, then the money holding cost is too high, so trade volume is small. That means that the value of preference information is low, so that is, its price is low. So the company cannot make sufficient profit, so it does not run its business. That means it does not issue any e-money. Third, so in the model, the social benefit of the e-money business, so issuing e-money and analyzing the data to get some information, so that's a social benefit, is higher than the private benefit to the company. So under some condition, socially efficient e-money business does not exist unless the government provides some subsidies to the company or to the final user of the information that are producers. And finally, when multiple e-money issuers issue their own digital currency in the economy, then the government can achieve a Pareto improvement just by imposing a price ceiling on the the price of the preference information. So, for example, if the government says, okay, the e-money issuers cannot sell the preference information at a price higher than $100, for example, by imposing that kind of restriction, we can improve some welfare. Okay, there are a bunch of literature related to this paper. Let me just keep going, move on to the model environment. So it's based on Laus-Wright model, money search model, and so we have infinite horizon. And in each period, there are 3 sub-periods, morning, afternoon, and evening. And there are unit mass of buyers and sellers. And in the morning, buyers and sellers can produce and can consume. In the afternoon and in the evening, only buyers can consume, but only sellers can produce. And here delta is the fixed parameter that represents a privacy cost that I will discuss later. Yeah. And 1 unit of labor supplies produces 1 unit of perishable consumption goods in each sub-period. And there are comparative markets in the evening and afternoon markets, and there are bilateral meetings in the evening. I use Carlyle bargaining rule, and in particular, seller has some positive bargaining power. As a standard in money search model, agents are anonymous and there is no record-keeping device, so assets are necessary for trade to occur. And the government supplies fiat money that grows at a constant growth rate of gamma. In this paper, I call fiat money P money, that represents paper money. Okay. So up to now, almost same with the standard money search model. And now I'm going to introduce some new assumption. So in the model, there are infinite number of evening tastes. So for example, some special taste for spaghetti or sushi or some blue jean, for example. And in each period, n number of evening tastes are randomly chosen from this infinite set. So this period, okay, blue jean is quite famous, okay? For example, there are some healthy concerns, so people prefer some organic food, for example. Each buyer has one of those evening tastes with this probability. So this period, I have some taste for spaghetti. And next period, maybe I prefer having some sushi, for example. And buyer's evening taste is realized at the beginning of the afternoon. If buyer consumes customized goods tailored to his evening taste in the evening market, then he enjoys high utility. So here, alpha times u of x is buyer's utility in the evening market, and if he consumes a customized product in the evening market, then alpha is alpha h. Otherwise, alpha is alpha l. Okay, so buyers want to consume some customized products. But to produce customized products in the evening market, sellers must prepare the production of that products in advance before they having some bilateral meetings in the evening market. So to produce spaghetti, the seller must prepare some noodle and tomato and some maybe beef, for example. Okay, so before he meets some customer. Okay, and to prepare the production of customized products, a seller must incur some fixed labor cost. But as I said before, there are infinite number of evening tastes. So without knowing what are the realized evening tastes in the current period, sellers will not prepare the production of customized products, right? He cannot do it. But the problem is that buyers' evening tastes are their private information, so sellers do not know which evening tastes are realized in the current period. And buyers prefer to keep their personal information, such as address and social security number, but also including their evening taste profit. They just don't want to give any personal information, including their preference to others. But maybe it's possible that sellers may contact to a number of individual buyers and ask them, okay, what is your evening taste? Please tell me, then I will pay some money. If that's feasible, right? However, there is no way to verify whether individual buyer provides correct information or not. So that means that buyers always will provide incorrect information to keep their privacy. So up to now, there is no way for a seller to obtain information about the realized realized evening taste. Okay, so we need something more. Okay. The second important assumption is that at the beginning of the morning, buyers are subject to a idiosyncratic preference shock. So with the probability of rule, a buyer goes to the afternoon market, and we call them early buyers. And with the probability 1 minus rule, a buyer goes to the evening market, and we call them late buyer. But here, even early buyers who go to the afternoon market, they have some special taste for evening goods, right? So for example, I want to consume spaghetti right now, so for in the evening goods. That's my preference. But I am so hungry, so I cannot wait for finding some spaghetti, nice restaurant that provides some spaghetti. So I just go to the convenience store and have some instant noodle, for example. So early buyers are kind of a consumer who needs urgent needs to consume goods. Even though they have some special taste and they cannot find some goods that are perfectly tailored to their taste in the afternoon market. Okay. However, early buyers' evening taste could affect their consumption behaviors in the afternoon market, even though there are no goods that are perfectly meet their evening taste, but somehow their preference could affect their consumption behavior. So, for example, there are a lady and gentleman here, and both of them are enjoying some coffee at home. So, doing some meditation or seeing the nice, beautiful sunrise in the morning at their home. But the problem is that they don't have a fancy espresso machine at home, and they don't have a nice skill to produce some nice coffee. So what they do is, instead, they go to the Starbucks early in the morning to buy a cup of coffee, even though what they really wanted is a cup of coffee, nice coffee at home. So they don't want to go to the Starbucks and waiting in a long line, but unfortunately, they cannot have a nice coffee at home, so they go to the Starbucks. So that means that transaction patterns in the afternoon market could reveal some information about their evening taste. So for example, if many people go to the Starbucks maybe early in the morning, then maybe we can guess that, okay, there are high demands for high quality coffee, for example. So why don't we develop a fancy Nespresso capsule coffee machine, for example, okay? And so afternoon transactions are useful, provide some useful information, but if everybody uses paper money, then we cannot observe afternoon transaction, right? So I introduce e-money. So there is a private company, and it issues e-money, and that is fully backed by P-money, government supplied fiat money with a 1-to-1 exchange ratio. So it's exactly the same with PayPal or WeChat Pay, for example. And the company can observe e-money transaction data, and by analyzing afternoon transaction data, the company can obtain information about the realized evening taste in the current period. So in the model, I assume that the precision of the information increases with the mass of e-money users in the afternoon market. And then finally, the company sells the preference information to sellers, because the seller can prepare the production of customized products by using that information. Okay. But the problem is that to use e-money, an agent, in particular a buyer, must open an account at the company. When open account, he must provide some personal information such as his name and address, right, for example. And also he agrees that he must agree that, okay, my personal information can be used by the company. Okay, and the personal information include transaction data. So it's kind of when we open some account at social media, we provide some our personal information. And I don't know about you, but whenever I open a new account, somehow I am hesitant when I open an account because there are some bad experience, not my experience, my own experience, but I heard, okay, there are some bad experience. Some personal information was revealed to some black market, so people get a lot of spam mails, for example. Okay. So therefore, a buyer incurs a fixed DC utility delta whenever he opens an account at the company. Or alternatively, we can assume that a buyer incurs fixed utility when he uses the e-money, okay? But it does not change the result. So if there is no compensation from the company, nobody will use e-money because of privacy cost. But the company needs afternoon transaction data, so it must make early buyers use e-money, right, in the afternoon market. To do that, it provides some fixed reward. It provides some rewards for using e-money in the afternoon market. And rewards can be fixed reward and also proportional reward, or combination of them. But the profit maximizing company does not provide any proportional rewards because it distorts a buyer's decision about money holding and creating some additional cost to the company. So in the model, evening transaction data are useless. So the company company doesn't need any evening transaction data. What they need is afternoon transaction data. Therefore, the company will not provide any rewards for using e-money in the evening market. That means that late buyer who go to the evening market will never use e-money. So they will use only P-money, paper money. However, early buyer may use e-money if the company provides sufficient reward for using e-money in the afternoon market. And depending on whether early buyers use e-money or not, we have two types of equilibrium. Okay, yeah. P equilibrium, in which everybody uses paper money, and E equilibrium, in which early buyers use e-money. And this figure shows the existence of each type of equilibrium given some parameter. On the vertical line, I put the sum of privacy cost and seller's investment cost to prepare some production of customized goods. On the horizontal line, I put the inflation rate gamma. And as you can see here, as the privacy cost and this cost increases, it's more likely that we have a P equilibrium. That makes sense, right? If these costs are sufficiently high, then the company cannot make profit, so positive profit, so it will not issue e-money. The interesting part is the inflation rate. So as the inflation rate increases, it's more likely that e-money is not used in equilibrium. Why? So in the model, as the inflation rate increases, the trade volume decreases, which is very standard result in monetary economics. But as the trade volume in the evening market decreases, the increase in sellers' surplus by producing customized goods decreases. So that means that sellers' incentive to prepare or to buy preference information decreases. So preference information price decreases, so the company cannot make sufficient profit, so it will not issue e-money. Okay. The second interesting part is that in this middle region, we have multiple equilibria. Why? So in the model, late buyers carry more money into the evening market if they can buy customized goods. If I can consume nice spaghetti in the evening market, then I will bring more money because I love spaghetti. Okay. So in the middle region, the equilibrium type depends on expectation. So for example, if late buyers expect that, okay, I can buy customized goods in the evening market, then I will carry sufficient amount of money into the evening market, so trade volume in the evening market will be sufficiently high. So sellers are willing to pay high price for to obtain information, so the company can make some profit, so it will issue e-money and running the business. So at the end, late buyers indeed can consume customized products in the evening market. So expectation is correct. On the other hand, if late buyers expect that, okay, I cannot buy customized goods, then I will carry less amount of money, which disincentivizes sellers to prepare the production of a customized good. So the price or the value of preference information decreases, it's low. And that means price is low, so the company cannot make profit. So the company does not run its business and does not issue e-money. So that means it cannot recover information. So sellers cannot prepare the production of customized goods, so late buyers will consume non-customized goods. So their expectation was correct. So because of these strategic complementarities, we can have multiple equilibria. And in the paper, I also conducted some welfare analysis, and I used some of utilities in a steady state equilibrium across agents with equal weight as our welfare measure. So the first two terms are surpluses in the afternoon and evening market, and the last term is the social cost of e-money business, such as privacy cost and sellers' investment cost of preparing the production. As you can see here, e-money business improves welfare by making late buyers to consume customized goods, which raises alpha here. So that is good part. On the other hand, e-money business negatively affects welfare because of this privacy cost and sellers' investment cost. So depending on which effects is higher than the other, e-money business can be good or bad, right? But in the model, so early buyers, whenever they decide whether to use e-money or not, they only care their privacy cost and rewards. They don't care so late buyers benefit. So they do not internalize the positive externality that their behavior imposes on late buyers' utility. And second, the company sells the preference information to the seller. So the price of preference information does not reflect the late buyer's benefit from consuming customized goods. That means that social benefit of the e-money business, issuing e-money and generating information, is higher than the private benefit to the company. So that means that whenever the company can make some positive profit, e-money business is good. So it's good to have e-money business in the economy. Another interpretation is that socially efficient e-money business may not exist under some condition. Okay? So in that case, it's good. The government can improve welfare by subsidizing the e-money business or the company, or provide some subsidies to sellers for using e-money, for using information, for example. In the model, so in a monetary model, welfare decreases with the inflation rate. So as inflation rate decreases, welfare and trade surplus increases. But furthermore, as I showed in the previous slides, as inflation rate decreases, it's more likely that we have e-money business in equilibrium. So welfare always decreases with the inflation rate, so the optimal monetary policy is the Friedman rule. Okay, finally, up to now, I assume that there is a monopoly company, okay? And now let's introduce free entry. So there is a pool of infinite number of companies, and each company can issue its own digital currency, and can estimate evening taste information by analyzing its own digital currency transaction data. So PayPal analyzes PayPal transaction data to get some information, and WeChat Pay analyzes WeChat Pay transaction data to get some information. A buyer must incur this utility whenever they open an account at different companies. So to use WeChat Pay, I have to incur some this utility for providing my personal information to WeChat Pay and incur some utility for using PayPal, for example. And of course, in equilibrium, all active companies will sell the information at the same price because sellers will buy preference information from a company that sells at the lowest price. If there are multiple companies, sellers randomly choose one company among them. And because of free entry condition, each company will make zero profit in equilibrium. But still, it's optimal for a company to provide fixed rewards, and that means that trade volume and the existence of each type of equilibrium does not change. It's exactly the same with the baseline model. But the difference is that under some conditions, we can have multiple E-equilibria with different numbers of e-money issuers. So specifically, as the number of e-money issuers increases, so price of preference information increases because of zero profit condition. So if there is additional e-money issuers, then each company will sell preference information to a lower number of sellers. So to get the zero profit condition, the price should increase. That means that sellers will buy preference information at a higher price, so seller surplus decreases. And this surplus goes to the early buyer because they receive rewards from more e-money issuers. But they incur price cost more, so early buyers' utility welfare does not change. So an increase in the number of e-monies only decrease seller surplus and welfare. So that means that we can have a Pareto-ranked multiple E-equilibria. In particular, welfare is low with more e-money issuers and higher preference information. That means that by imposing price ceiling on preference information such that, okay, only one company can make zero profit under this price ceiling, then we will have only one company, so we can achieve Pareto improvement. Okay. So to conclude, so in the model, so e-money may not exist if inflation is sufficiently high and socially efficient privacy utilization, e-money business may not exist under some condition, and because of strategic complementarities, we can have multiple equilibria, and introducing a price ceiling on preference information can improve welfare. So we can achieve Pareto improvement when multiple e-monies are circulated in the economy.
Okay, so thank you very much for putting this paper on the program, and thank you for staying to the last session. This is joint work with Markus Brunnermeier on platforms, tokens, and interoperability. Okay. Can everybody hear me fine? Is it? Okay, great. Okay, so as a lot of people throughout this conference have pointed out, we've seen the emergence of a wide range of new digital tokens. What's different about digital tokens compared to cash? Well, digital tokens require a ledger, right? You need a ledger to keep track of who owns what and to undertake transactions. This has led to a lot of innovation in ledger technology and some exciting and also extremely ambitious attempts to try to reorganize the financial sector. So we've seen the attempt to move supply chains or reorganize supply chains by putting payments, inventory tracking, and automatic contracting between different people in the supply chain onto some transparent, open, commonly observable ledger that people can use to write these contracts. We've seen big tech platforms attempt to enter finance by offering tokens and/or consumer credit, and particularly in the case of Meta, butt heads with regulators quite frequently. So ultimately, the perspective of this paper is we think that these changes pose some difficult and very interesting I/O questions about how control of ledgers can be used strategically by big players in the economy. And this is what we try to understand in this paper. So specifically, we try to go after three main questions. So So first, we try to understand what are the synergies between offering something like a trading marketplace or trading platform and a digital ledger when there is a world with a supply chain. Then we think about how the bundling of a trading platform and a digital ledger changes competition. To what extent can the controller exploit their market power? And then finally, we think a bit about how policymakers might respond. What about things like open banking that give data privacy or CBDC? Okay, so that's what we go after in this paper. How are we going to approach it? Well, this is a theory paper, so we're going to put forward a theoretical model, a new model of a supply chain with an incumbent profit-maximizing platform that provides both a matching technology for people to trade and also a digital ledger that it uses to create tokens, organize payments, and allow agents in this supply chain to write contracts with one another. This ledger is going, or this platform is going to face competition from a number of different dimensions. Right? So one level of competition is it's going to face competition from a potential entrant platform that has an alternative matching and ledger technology. This means that the incumbent is going to have to design so-called interoperability. So that is, how easy is it to move information and tokens from their ledger to some other ledger that comes into the economy? Okay? So there's going to be this competition at the level of the platform. Then, we may not get to it today, we'll see how we go, but then we also have competition with money. So a more traditional currency competition where there's some kind of government money in the economy, and so the incumbent has to design the relative usefulness of their tokens as a medium of exchange compared to government money in the economy. Okay, so we build this model with a profit-maximizing platform and these two different layers of competition. What do we get out of it? Well, in answer to the three questions I started with, the good news on the synergy front is we see a synergy in the sense that this platform that controls the ledger, has all the information about the trades, and is able to exclude people from the matching service, is able to provide uncollateralized credit that would not be able to be provided without this platform that bundles all these services together. Okay? So the good news is we get more lending. The bad news is that the incumbent is able to use their control of the ledger to gain market power. And they do this essentially by finding ways to lock people into their ledger. Right? So they restrict the portability of transaction histories, and they set token exchange fees, so it's hard for agents to move. They also promote the portability of contract information across ledgers, so that even if agents do move, their contracts move with them, and so they can't sort of escape the ledger and default. All of which makes it hard for agents to move across ledgers, and so these all deter new platforms from coming into the market and ultimately allow the incumbent to charge high markups or fees. Okay? All right, so we get a synergy, so we get more lending, but we get more market power for this incumbent platform that does everything. What should policy do? Well, policy here really needs to balance, trying to preserve the synergy. So going back to the question you had before, there's economies of scale here, right? It's good to have this big platform operating. So you want to preserve that, but you need to find some way to try to make them act more competitively. So we look at some options, and ultimately, if we get to it, sort of CBDC with a programmable ledger looks like a really good option in this environment, but we can say more about that as we get through the talk. Okay. I won't ask if there are any questions so far, because I guess I take questions at the end. Is that okay? All right, great. So there's a lot of literature. We can come back to it if people are interested. If I've left someone off, I apologize very much. You can let me know. Otherwise, I'll move on to the model and the environment. Okay. So this is going to be a continual, I should just say. So we'll start with the environment. Then I'm going to discuss a monopoly platform that faces no competition. Then we'll think about competition between an incumbent platform and an entrant platform. And then if we have time, we'll get to currency competition at the end. We have different currencies circulating. Okay. So what does this environment look like? Well, it's going to be a continuous time, infinite horizon OLG economy with one consumption good. It's going to be populated by a collection of agents who follow a life cycle in a supply chain. So what does this mean? Well, the agents arrive without any resources, but with the opportunity to participate in production by either providing labor, where they provide this utility to a certain number of labor units, or they can hire labor and produce goods. We hear they hire our labor, and then they have a production function with idiosyncratic productivity Z. Okay? So they arrive as laborers or producers. After they've participated in production and they've sold their labor or their goods, they then become consumers with linear utility and after they've had the opportunity to consume, they exit the market. And as an aside, we have that while they're waiting to consume, they also get services or service utility from hiring labour. Okay. So this is the world. The agents are going to need a bunch of services to get this supply chain to run. So these producers are going to need some access to credit in order to be able to pay the labourers. So we need credit in this economy. We need currency for all these transactions to take place. And the agents are going to need to be able to match to do all this trading, particularly in the goods market. All right, so let's go through the technologies we have available to try to provide these different services. So on the markets and matching technology first. So we have here a world where we're going to assume labour is traded in a Walrasian market, right? For convenience, labour is frictionless. The difficulties all come in the goods market. So here, in order to trade these consumption goods, the buyers and sellers have to use this matching technology. So for buyers who are holding their currency, they search and they get trading opportunities at some rate lander B. The sellers who hold the inventory, they search and they get trading opportunities at lander S. Okay? And then at each time, a Walrasian market opens up for all the buyers and sellers who got trading opportunities. So we're not going to worry about bargaining or any of these things that often come into search models, but you have to use this matching technology to try to find trading opportunities with each other. Okay. So this is the first technology for trying to get buyers and sellers to be able to meet in the goods market. All right. Second technology is a ledger. So how does this work? Well, the agents here are going to lack commitment, and there's going to be no legal system to enforce contracts. So you should think of this as a supply chain that's operating across different countries, across different legal jurisdictions, so we don't have a clear and easy recourse to some legal system to resolve contracts. All right. What about agent actions? Well, the agent actions are not going to be publicly observable, but there is going to be a ledger technology that can be used to record what everybody is doing. Okay? So in keeping with sort of recent ledgers we've seen developed, particularly in the DeFi space, we're going to think about this ledger as consisting of token accounts and contract accounts. A bit more formally, we're going to think about the ledger as a collection of three things. There's a filtration or history generated by all the reports that have come to the ledger over time, right? It's recording the history of the economy. It has a whole collection of token balances, or a process for token balances, that has to be adapted to these histories. And it has a whole bunch of contracts that impose restrictions on how the token balances can evolve. Okay? That's how we think about a ledger here in the abstract sense. All right. So that's the technology. We have a matching technology and we have a record-keeping technology. We're going to use this to try to provide the currency and credit arrangements that are going to get this supply chain working. So the arrangement we're going to focus on to start with is this one here. We use this not because it's the only arrangement. There are multiple optimal arrangements in this environment. We use this because it's going to illustrate clearly. We can come back at the end and talk about other market arrangements later on. But for the moment, let's focus on this one. So the ledger owner is going to create a fixed supply of tokens that give the token holders a share of ledger revenue. Okay? So it's a little bit like these agents are going to use sort of shares in the ledger to trade and do transactions. The ledger controller is going to be able to charge a fee for contracting on the ledger. This is how they're going to earn their income. Okay? So we're going to call this contract fee kappa P. And then the agents are going to write contracts. Okay? So all these agents that are searching for consumption goods, right, that have sold, that have collected currency, that are searching for consumption goods, they're going to pool their tokens together into a fund on this ledger, and they're going to write contracts. They provide tokens to producers to purchase labour, and then divide the sales revenue between the sellers and the fund, and also pay the fee to the ledger for using their services. Okay? These contracts are going to be traded competitively on the ledger, given the fact that the ledger controller is going to charge a fee for using it. Okay. So we have this provision of credit in this economy. The key thing is, when can these contracts be enforced? So throughout all the arrangements we're going to look at, we're going to be able to have contract enforcement so long as the ledger has the appropriate trade and contract information to know when the contract should be executed. Right? So it needs to know the terms of the contract, and it needs to know when trades happen in order to be able to execute the contracts. And of course, the token accounts have to have sufficient tokens to fulfill the contract. So there's a budget constraint. Okay. So that's the environment. Okay. So we've got the ledger, we've got the matching technology, and we've got this market arrangement to try to provide credit. All right. So let's step through the different problems. So I'm going to start with the monopoly platform, and then we'll get on to platform competition. How am I going time-wise? 10 minutes. Okay. So let's think about the monopoly platform. So in this case, we can definitely enforce the contracts, right? So the monopoly platform controls both the ledger and the matching technology. So this really ensures they're able to enforce contracts without a lot of hassle, because they can require the sellers to post a contract that they're going to repay when they search on the matching technology. In other words, the platform can force the sellers to de-anonymize themselves or be excluded from the matching service, right? They can then share all this trading information with the ledger, right? So the ledger has all the history of token exchanges plus all the goods trades. So the ledger has all the information to be able to link inventory sales to contracts and enforce all of these different contracts. Okay. So in this case, the platform can definitely enforce the contracts, and really all it has to resolve is, okay, how big a fee does it want to charge? So it gets the fee revenue subject to respecting market clearing in the labour, goods and contract market, and subject to the law of motion for the aggregate inventory, which depends on how big a fee they're kind of charging in the production process. Okay. All right. So that's the platform problem. What do we get as a solution to this problem? So in the simple case, we get nice functional forms, right? So they're going to choose a positive markup. They're going to end up with this amount of inventory in the economy, and they're going to earn positive profits. Okay? There are two comparisons here that are going to be useful. So first we can compare to a planner, and then we can compare to an operator that only controls the ledger but doesn't also control the matching technology. So if we compare to the planner solution, if we compare to a planner who maximizes welfare in this economy with all the information, but subject to having to respect the matching technology that's there in the economy. Okay? So if we compare to this planner, well, if the monopolist behaved competitively, right? So if the monopolist charged no fees, then they would earn zero profits and we would get the planner allocation, right? Because this monopoly platform has all the information to be able to enforce the planner solution or get the planner solution. The problem is they use their market power to charge rents, and so they don't behave that way. What about if we had a ledger operator, right? So if there was an operator that controlled the ledger but didn't also control the matching technology. So they only have part of the information in the economy. They see the transactions, the token transactions, but they don't see what the token transactions are for. Well, in this case, there's no policy of the ledger operator that could generate the planner allocation. And why is that? Well, it's because they're missing this information, right? So what they have access to is they see all the token exchanges, but they rely on agent reports about what the goods trades could be. So the ledger cannot distinguish between token exchanges that are from labour sales versus goods sales, so they can't work out when the contract should be enforced. Okay? So in this case, they have to start doing kind of imperfect screening solutions, a little bit like what was talked about in the first talk, to try to work out how they can enforce some contracts, but they can't implement the planner allocation. Okay. So all of this is to try to convey that we get some benefit from bundling all these together. This is the economies of scale in this economy, right? Are you going to ask a question? I thought that.
Just a quick one. So the ledger operator, in terms of efficiency, I understand it doesn't reach the planner allocation, but is it better than the monopoly case? It's not really clear.
It's not clear. It's ambiguous, right? Because the monopolist has more market power, but it also has more information. So there's ambiguity here, right? So absolutely, absolutely. And that's why from the policy perspective, we like the bundling, but we really want to try to get the monopoly platform to behave more competitively, right? That's the name of the game here. So we can't move to a world where we have an infinite number of platforms because we lose this synergy benefit. We have to somehow work out how to get this big player to operate more in the public interest, right? That's exactly what you're getting at. Okay. So with that in mind, we start to think about different ways that this platform might face competition. So let's start with the first one, which is competition from a potential entrant platform. That's no problem. So how do we think about this, right? So we allow that at any time, a new platform can enter the market and challenge the incumbent platform. Okay? So the incumbent platform will be noted platform 1. The potential entrant is going to be denoted platform 2. We're going to restrict attention to equilibria where the incumbent deters entry, but of course we have to think about what would happen if entry occurred off equilibrium path to understand how they deter entry. Okay. So once we have this other platform in play, we have an additional strategic choice that the incumbent has to make. They have to choose how they want to link their ledger to other ledgers that might come into the economy, right? So here we think about the portability of the information on the ledger. So we have a choice, right? We're at one extreme, the incumbent can choose to make their information very portable. So in this case, when the new entrant comes in, they observe all the token histories and they observe all the contracts that have been written, and they essentially have the same information on their ledger that was on the incumbent. Okay? At the other extreme, we could think about no portability, where the entrant observes nothing and has to start building information from scratch. So what's the trade-off here from the point of view of what happens in the market? Well, the entrant is only going to be able to enforce the incumbent's contracts if the ledger is portable, right? So if the incumbent wants contracts to be enforced on the new entrant platform, they're going to have to give the contract information and the history information out to the entrant coming in. But there is a trade-off that the entrant matching technology depends on how much information they have from the previous trading histories, right? So the more information they have about what people have done before, the closer they can provide to the matching service of the incumbent, okay? So we have this trade-off here about how you get contracts enforced and how the entrant can provide a better trading technology. Okay, so the way we do the timing here is, so at the beginning of a time period, we come in and the incumbent has chosen its policies, right? It's chosen its fee structure and it's chosen its portability. The entrant then contests the market, so all the agents immediately decide whether to trade on the entrant platform. If the entrant can attract the agents, then they become the new incumbent, otherwise the entrant leaves. And then after the trade occurs, these contracts are resolved, right? So if the entrant wins the contest, there's potentially a whole bunch of orphaned contracts. Contracts that were written on the old ledger, but now we have a new platform with a new ledger. So in this case, the entrant incumbent bargain over what will happen with any contracts that are enforceable that have been orphaned. Okay, and the entrant bargaining power is going to be delta. Okay, this is the attempt to get a clean and tractable contested markets model to think about competition between big players in this market. All right, so how does this adjust the problem of the incumbent platform? So now the incumbent platform chooses not only a fee, but also how open or how connected it wants its ledger to be to other ledgers that might appear in the economy. And it faces a non-participation constraint that it has to deter new platforms from entering this market. Okay. So the key thing to understand is the entry decision of a new platform. So when a new platform is looking at the market and saying, should I enter or should I not enter, they make the decision based on this, right? So they're not going to enter the market if the value of becoming the new incumbent minus the net cost of winning control of the market is less than 0. And what determines this net cost of winning control of the market? Well, in the paper, we get a fairly clean expression for what this looks like. The net cost really depends on two things, right? It depends on the compensation they have to give to agents for offering a worse matching service, right? So if you're not able to give as good a matching service as the incumbent because you don't have the information, you're going to have to compensate the agents for that to get them to move across to the new platform. On the other hand, if all these sellers move across that have contracts, they can move across in default, right? So they can allow these sellers to move across in default and they can get extra fee revenue from them when they do that, right? So they have to pay compensation for the worst matching service, but extra fee revenue when default happens. So what does the incumbent want to do? Well, the incumbent wants to maximize the cost that the new platform faces when they contest the market. And so how does information portability impact this? Well, we get a trade-off, right? If they decrease the portability of information, yes, they decrease the quality of the matching service of the new entrant platform, which means they have to pay more compensation to agents, which pushes up the cost. But at the same time, contracts are less enforceable. So all these contracts that were written on the old ledger, the new entrant cannot enforce any of them. They cannot bargain over enforcement. They just get lost. And that means that the new entrant can come in more cheaply because they can offer agents this ability to come over in default. Okay. So out of all that, what ends up happening? So in a lot of cases, the incumbent is going to choose to have no portability. They're going to have a closed-off ledger so long as this decrease in matching rate is when they don't have information is small. Okay? And they get a loan fee and they get the incumbent value. Okay. So in this world, we want to think about how we could induce competition. So one thing that's been talked about a lot is giving agents more control over their own information, or something like an open banking regulation to allow people to access information and come into the market. So we can think about what something like that would look like in this environment. So if we had open banking or a data privacy regulation that gives agents the right to veto the portability of their information. So in this case, we need to think about the transaction histories and the contract information moving potentially separately, right? Each type of agent can veto how their information is going to be moved. So if we have this choice, then the buyers are going to allow their information to move, but the sellers are always going to veto their contract information from moving. And so we end up in this situation where essentially the agents are going to do the opposite of what the platform would want to do, right? They're going to make it really hard to move they're going to make it really easy to move the transaction histories, but hard to move the contract information, which ultimately means that the incumbent is going to get a negative value in this market because there's too much default that happens, and they wouldn't want to set up this platform in the first place. To understand what's going on here a little bit, let's think about this a little bit more intuitively. So really the way I think about this is the agents have different exposures to information on this ledger. So the buyers who have currency, they really have a positive information exposure because all the transaction histories that are stored in the ledger help them trade better, right? Whereas the sellers who have the inventory and the loans, they really have a negative information exposure because it's all their, having all the contract information is what enables to enforce all the contracts and all their debts. So really the platform and the buyers and sellers, they want to do opposite things, right? The platform wants to restrict information portability for agents with positive exposure and promote it with negative exposure, right? They want to prevent the transaction histories from moving, so they lock in the agents, right? So you can't take your transaction history with you and get the better service on the new platform. But they want to make contract information very portable to mitigate the ability of sellers to move and default. So I think this is quite similar to what the current banking system does, right? So banks share a lot of information about default and credit registries, but they make a lot of attempts to hide transaction histories so they can provide their services. Okay. And then buyers and sellers choose the opposite. Okay. And very quickly, why do we end up with credit not being provided? Why is it vulnerable? Well, the issue here is that the incumbent platform has made a commitment to use payments on their ledger to repay lenders. But the uncommitted entrant platform can persuade borrowers to move by allowing them to default. They've made no such commitment, right? And so the incumbent platform needs to run a loss to deter entry. This is what makes it kind of vulnerable to try to provide credit in this environment. And so the incumbent needs some way to compensate for this effect by restricting the portability of contract information or restricting the portability of tokens that I won't get to for time constraints, but we also talk about. Okay. So very quickly, we have two extensions. We talk about competition with government cash. We think about a public marketplace with side trades and money issued by the government. And here we have this extra choice where the platform has to choose the exchange rate at which their tokens can be converted back into dollars, which creates an additional kind of feedback loop where they can try to trap people in. And then we think about CBDC. And we show that CBDC with the programmable ledger here is kind of a silver bullet for resolving a lot of these problems. Okay, so I'm out of time. So in answer to the questions, do they create synergies? Yes. Do they create market power problems? Definitely yes. How does the regulator respond? Well, they have to try to work out how to preserve this synergy. Open banking doesn't really look like an answer. They really need to provide a different kind of competition. But I'm out of time to talk about that. Thanks very much.
So thank you for staying on to the last paper in the last session. And this paper is a bit different than the other ones. It's not about information, and it's a joint project with two colleagues of mine, with Lea Bitter and Annukka Ristiniemi. And of course, these are our own views and not views of the European Central Bank. So what we are doing is that we are trying to model CBDC as a means of exchange and look how this affects the transmission of macroeconomic shocks. And the challenge is if you go for a regular, normal business cycle model, a New Keynesian model, there is no explicit role for money. On the other hand, you have these new monetarist models that model monetary exchange, but they basically do comparative statics and they don't do a dynamic analysis of shocks. So what we are doing is we integrate a Lagos and Wright decentralized market, so a new monetarist type model, into a Gärtner-Karadi New Keynesian model. And this is something that first had been done by Aruba and Schorfheide. So they had one a decentralized market and a centralized market, but what we are doing is we are analyzing this in the context of CBDC. So we have two different means of exchange on the decentralized market, and we have a much richer centralized market with monetary frictions and balance sheet constraints for banks. So in this setup, we introduced CBDC to study impulse responses to different shocks. So findings are CBDC allows the central bank to target the two functions of money differently. So we have a conventional Taylor rule, which allows us to target the store of value function of money, and we have a CBDC rule, which allows us to target the means of exchange function of money. So this model has a liquidity premium, so CBDC has a value as a means of exchange, and by targeting this liquidity premium, the central bank can dynamically influence payment conditions. And thereby we have a trade-off between payment efficiency, bank funding conditions via deposits, and the opportunity cost of holding money via the interest rate. So existing CBDC studies either use a new monetarist framework, so there are a number of papers around, these are just free, so I have a paper with other colleagues and other co-authors. We have Ristiniemi, we have Kee-Youn and Sanchez, or they use a New Keynesian approach. Examples are Ferrari, Straka and Mehl, or Boulogne et al., or Gross and Schiller. So with a New Keynesian approach, you typically have money in the utility function set up and no micro-funded role for money as a means of exchange. So our model integrates both perspectives, and we investigate effects, monetary policy effects, in the presence of a CBDC. So this is the model. So I will spend a bit of time on this. So we first have a centralized market, which alternates with a decentralized market. So in the morning you have the centralized market, and then in the afternoon you have the decentralized market. And on the centralized market, we have the usual New Keynesian setup. So we have capital goods producers. They use capital and refurbished used capital and supply the intermediate good producers with new capital. There are investment adjustment costs. Then the intermediate good producers, they produce a retail good, and they use labor, and they have to fund themselves from the banks. So they issue securities to get credit from banks, and they produce an intermediate good. The intermediate good is sold to retail producer goods. There you have sticky prices, monopolistic competition, and the retail good is sold to the households. So this is the typical New Keynesian setup, that you get a role for monetary policy by having these three different types of firms. The central bank can do quantitative easing. So it holds the security that is issued by the intermediate good producers. So banks are subject to an agency problem. Banks take in deposits from households, but if they have, they have an incentive to run if they can make more profits by taking the deposit and just going out of the market. So therefore, they won't get, deposits are capped at some value. So households won't entrust them with a high amount of deposits, because they know that there is this friction that the bank could default on the deposits, take them and run. So this means that capital is in short supply. So this is the balance sheet of the banks. They have assets on the securities that is issued by the intermediate good producers are on the asset side of the bank balance sheet, and the deposits are on the liability side. And since you have this incentive constraint, there is too little funding from the bank to the intermediate good producers. So we have a friction there. The central bank can alleviate this by buying some of the securities of the intermediate good producers. And this is how QE would work in this economy. So then we have the households. The households supply labor, they purchase the retail goods, they pay taxes, they hold money or bonds, and the households deposit their savings with the bank, and they get an interest on that. And then that's the typical Gertler-Hardy setup. And then we have the decentralized market. So when the centralized market is over, households receive a preference shock that splits them either into buyers or sellers. And this happens with a probability sigma. So with probability sigma, a household is a buyer, and with probability sigma, it's a seller, and with probability 1 minus 2 sigma, it has not a trading opportunity on the decentralized market and will just keep their funds up for the next centralized market. So, and here we have either the household becomes a shopper, then it uses deposits or CBDC to buy, and in the decentralized market, households do have to have some means of payment. So either deposits or CBDC. They can't pay with capital or they can't pay with bonds. And so the shop owners, they produce in the decentralized market and they sell the good that they produce in the centralized market, in the decentralized market. And then we have the next period where all these allocations are set back to standard allocation, which is the usual Lagos-right setup. So looking at the household problem in more detail. So this is the value function of the household in the centralized market. So the household maximizes their consumption, labor, money holdings. So this is CBDC, deposit holdings and bond holdings. And it maximizes the consumption, the utility from consumption on the centralized market. It has a disutility from supplying labor, and it has the value function for the decentralized market that will happen in the second part of the period. And this is the budget constraint, so consumption, CBDC holdings, deposit holdings, and bond holdings have to match labor income, taxes, and the return on their money holdings, deposit holdings, and bond holdings. And this is the payout from the banks and any lump sum taxes. So the households own the banks and the households own the firms. So any return that comes from firms or banks is in this omega. So the household can invest their savings either into CBDC, into deposits, or government bonds, but only deposits and CBDC can be used to trade on the decentralized market. We have a linear disutility of labor. So here this is linear, and this is the usual setup to rebalance allocations in the next centralized market. So if you had a concave or a convex utility, this wouldn't work. And the deposits are limited by the leverage constraints of banks, as I said, and this can lead to a potential restriction of transaction and consumption in the decentralized market. So we have on the one hand this financial friction that affects the intermediate good producers, but through the deposits, this financial friction also spills into the decentralized market. So on the decentralized market, households receive this preference shock that creates buyers and sellers. So the value function of the household on the decentralized market is sigma times the value function if the household is a buyer, plus sigma times the value function if the household is a seller, plus 1 minus 2 sigma the value function from the next centralized market, and this is discounted by the discount factor beta. Buyers want to consume but cannot produce, so they maximize the utility of consumption on the decentralized market plus the money holdings that they spend on the decentralized market. So we have the utility here plus any consumption on the next centralized market where their money balances and their CBDC balances, their deposit balances and CBDC balances are reduced by the amount that they are spending on the decentralized market. And we are assuming that there is a precautionary motive for money holdings, so they don't want to spend all of their holdings in the decentralized market, but just a fraction eta M or eta D. So, and the budget constraint is that the price on the decentralized market times the consumption on the decentralized market has to match their holding of liquid assets, so their, what they are spending in terms of CBDC and in terms of deposits. And as I said, they don't want to spend everything that they're holding, so they come into the market with capital M and capital D, but they only want to spend a fraction eta M and eta D. So sellers can produce, but they don't want to consume. So they have the cost of production of the decentralized market consumption good. And then they have the value of the next centralized market, where they go into with the initial amount they had plus the earnings they got on the decentralized market. So we have search with efficient matching and anonymity. So this means that there is a role for money. And the available money balances on this decentralized market determine the liquidity premium. And this in turn then affects the outcomes in the next centralized market. So we have a spillover from the decentralized market into the centralized market via the liquidity premium. So the allocations are evened out, but variables in the centralized market are affected through this channel. So the monetary policy, we have a Taylor rule. The bond interest rate follows a Taylor rule. So we have the equilibrium Taylor rule, and then the central bank targets inflation and the output gap. And in this case, the output gap and the inflation rate are defined over the centralized and the decentralized market. So the output gap is, output is the sum of output on the centralized and the decentralized market, and inflation is a weighted average of the inflation rate on the centralized market and the decentralized market. And these inflation rates are weighted by the steady state shares of the two markets. Then we have a rule that targets the CBDC interest rate. And if the central bank supplies as much CBDC that the liquidity premium is even out, so if the demand for CBDC is satiated, then it would mean that the interest rate on CBDC would equal the bond interest rate. And the amount of CBDC in circulation would be, we label that M bar. But we assume that the decentralized market is constrained, so there is a liquidity premium. There is a value of having a means of transaction, which means that the interest rate on CBDC is below the bond rate. So, and this is shown here. So the supply of CBDC is a function of the bond rate minus the deviation of money demand less the M bar, the saturation amount. So we have a constrained market, which makes a dynamic more interesting, because we then get into the region where there are differences between the interest rates in the economy. And to issue CBDC, the central bank also has to look at the asset side. So CBDC is a liability of the central bank, so we need to close the model by having something that the central bank puts on its asset side. And that's not fully innocent, the choice here. What we assume is that it purchases these government bonds. So you could also assume that it purchases private securities, but we want to have as little effects from the CBDC issuance on this financial friction. So that's why we're assuming that it's purchasing government bonds. So in the calibration, we stick as closely to the literature as possible. So most of the parameters, we take the same value as in Gadler-Karadi. We have a few additional values that parameter values that come from the decentralized market. So we set the participation, so this sigma shock at 0.2. So we have twice 0.2 the participation in the decentralized market. And this we target to reflect the steady state share of point of sale and peer-to-peer in total transactions in the economy. So we calibrate this to the euro area economy. So we are looking at what part of total turnover is done at the point of sale and peer-to-peer. We have the utility weight on DM consumption, which we calibrate to the liquidity premium of 1.4% in the euro area, so looking at the difference between deposit rates and bond rates. We have a payment fraction of CBDC and deposits in the decentralized market, where we take the difference between the main refinancing rate and the overnight deposit rate over the period where interest rate was still positive to calibrate this share, this payment fraction, and we arrive at 33% payment fraction. And finally, we follow our Hubbard-Schorfheide to set this effort elasticity for the M good production, so the cost of the producers in the decentralized market at 0.68. The parameters in the CBDC rule, so in this rule here, we set at the base issuance, the M bar is 0.001, which would amount to 15% money holdings in CBDC. So this is the share of cash in M1. So we calibrated to that. And we have a reaction parameter of 0.01, which is the interest rate reaction to CBDC demand. And finally, we have two parameters where we deviate from Gertler-Karadi. One is the investment adjustment costs, where we use the Smets-and-Wouters value, because Gertler-Karadi is targeted to the US, and in the euro area, this parameter value is different. And we have the relative utility weight of labor, which we set higher to the value of Hugo and Schorfheide had chosen, because here we have this linear disutility of labor, so the value is different. Yeah?
What do you mean by interest rate reaction to CBDC demand? How do you make a CBDC demand in the data?
This is here, this kappa M.
Money demand. But we don't see CBDC.
Yeah. We set it to money demand, so to have a reaction that allows us a meaningful parameter space to look at. And yeah, of course, this rule is, we cannot, yeah, we look at cash and say, well, we don't have cash in the model, so we calibrate CBDC at to cash, what we see at the moment, yeah. To get at values that are in the ballpark of what we probably could expect. So and then we are computing, so when we have the parameter values, we compute impulse response functions, and I'm going to show two shocks. So we have a shock to the liquidity premium, which we interpret as a payment technology shock, and we have a shock to banks' intermediation capacity, which is a capital quality shock. So this is the shock that banks have a higher cost of bank intermediation, which is something which in the context of CBDC is often discussed, that you get problems with bank intermediation. And what we find is that CBDC offers a new transmission channel for a monetary policy to work, and the liquidity premium plays a key role in linking the centralized market with the decentralized market. And the store of value function of money is steered through the conventional Taylor rule, and the medium of exchange function of money is steered via the CBDC rate through a CBDC rule. And the transmission in the model works as follows. So we have a tighter leverage constraint in the centralized market. So a shock, a payment technology shock, reduces the amount of deposits. Then less deposits means that the amount of transactions in the decentralized market is going to fall. And then the central bank can step in and provide means of payment and increasing the consumption in the decentralized market. And this in turn then spills over into the next centralized market. So dynamics in fact are very rich. And it basically works through the consumption opportunities in the decentralized market. So these are the impulse responses to a 5% shock to the liquidity premium. And what we are doing, so when we have the model, we first looked at whether adding this decentralized market makes a big difference to the original Gertler-Karadi model. And we find that, of course, the shape of the impulse responses differ a bit, but overall, qualitatively, the model still works in the same way. And then we look at simulations where we have either only deposits or we have deposits and CBDC. And if we go for deposits and CBDC, then the central bank has this additional channel where it can influence the supply of CBDC and thereby alleviate these financial frictions that are present in the model. So this is what happens here. So the black dashed lines are the impulse responses without a CBDC, and the red lines are the impulse responses in the model with a CBDC. And you can already see, so when there is a liquidity shock, the liquidity premium increases much more when there is no CBDC. When there is CBDC, the central bank steps in, provides CBDC, so we have a smaller rise in the liquidity premium. And you can see here, this is the increase in the CBDC. And you can also see that the share of CBDC in total money, so CBDC over CBDC plus deposits, is increasing. So with the CBDC, deposits fall. This is happening because consumers switch from deposit holding into CBDC. So you have a substitution there. Without a CBDC, deposits fall only a little bit. With a CBDC, you see that there is a big shift into CBDC, which can be also seen in this chart. This means consumption is decreasing less in response to this liquidity premium shock. And you can also see that there is a spillover into the centralized market. So when the liquidity premium is falling, when consumption is recovering, it overshoots and is increasing. And here you can see it very clearly that here consumption is disaggregated into consumption on the centralized market and on the decentralized market. And the action basically comes from consumption in the decentralized market falling less in the presence of a CBDC than without a CBDC. This also has influences, so output is not falling but increasing and returning more quickly to equilibrium with the CBDC. And we have a smaller increase in inflation and again a quicker return to equilibrium. So you can see that this additional channel is influencing the dynamics and is also helping the adjustment in the economy in the sense that convergence to steady state is much faster. So here we have a financial shock, a capital quality shock. The capital premium is going up. And again, so without a CBDC, a lot of this increase in the capital premium is going into deposit rates. So the liquidity premium is decreasing without a CBDC. In the presence of a CBDC, the liquidity premium remains much more stable because, again, the supply of CBDC is increased. The share of CBDC in total money increases. And we have a bigger reaction in deposits because of the substitution effect. Consumption is reacting a bit faster and falling less. The same is true for output. For inflation, we have at the beginning a fall and then almost the same trajectory, but a little bit less than without a CBDC. So overall, we are concluding that effects are somewhat different, but qualitative similar. So we have a somewhat quicker return to the steady state. Our model endogenously accounts for the role of money as a medium of exchange and introduces a new dimension into a new Keynesian model, which allows us to study these effects of a CBDC as a medium of exchange for business cycle dynamics. So I showed these three shocks, but you can, of course, look at all the other standard shocks in such a model. And with the CBDC, the central bank has two instruments that it can use to target different aspects of money. So the Taylor rule, the store of value function, and the CBDC rule, the means of exchange function. And the liquidity premium is key in transmitting the dynamics from the centralized market to the decentralized market. So I think I stop here.